and she wants to verify her net pay. So she has these deductions that show up on her pay stub. So her gross pay was $269. She had FICA tax of 6.2%, Medicare tax of 1.45%, federal withholding of $47.51, state withholding of $16.62, retirement, disability, medical insurance, and dental insurance. Okay, now federal and state withholding, those are income tax. Withholding and income tax are the same. Okay, so what you do, first we have to figure out how much is FICA. That's Social Security, 6.2%. So FICA is Social Security. So we're going to take 0.062 times her gross pay. And that's going to give us $16.72. And then we have Medicare, which is also a percent. So we take 0.0145 times her gross pay, and that gives us $391. Okay, so this was for Social Security, and this is for Medicare. So that's what she made, and then we have to start taking out everything. We take out her Social Security, we take out her Medicare, we take out her income tax, we take out her state income tax, we take out her retirement, we take out her disability, and her medical insurance, and her dental. Okay, what she has left over and what she gets paid is $155.43, and that's her net pay. Gross is what year statement. So if you look on here, you have amount and year-to-date amount. That's what YTD stands for, is year-to-date. Okay, and so that means they've totaled up all of the paychecks that she's received by this time. So that starts January 1st and goes to December 31st. And then the amount, this is the current. Okay, so we have her pay is $4,596.39. Year to date was $32,174.73. Social Security, this check, they're taking out $280.79 altogether for the whole year. So far, they've taken out $199.63. 1999. I missed a 9. Medicare, this check for the whole year so far. Taxes, this check for the whole year so far, etc., etc. Okay. Then she has. So these are the federal and state taxes and things that you have to pay. These are kind of voluntary. Union, family health insurance, retirement. You choose whether or not you're going to contribute to those things. And some of them come out pre-tax and some of them come out post-tax. Retirement usually comes out pre-tax. I'm not sure about union dues. I don't remember. What, retirement? No, retirement is money that you're putting into a fund, and depending on if it's an employee-sponsored fund, it's most likely a 401k account. But there's other, like there's IRAs and different things like that. And so what happens is that they're tax deferred, most of them. So they take the money out of your paycheck before taxes, so you don't pay taxes on that money now. But when you retire and you pull the money out of the account, you pay taxes then. You pay the taxes later. So we want to assume that this is, if we're assuming that this is the same all year round, every paycheck, how much will be taken out of her total annual gross salary for federal and state taxes? Well, we've got federal and state right here. Okay, and this is bi-weekly. So if we remember bi-weekly, how many paychecks is that? 26 checks, yeah. So I'm going to take that federal tax and the state tax, add them together. Okay. And then, let me double check myself. Multiply that by 26, because there's 26 paychecks. And she's going to pay $33,341.36 in federal and state taxes for the year. Now, you don't really have to deal with this because we live in Florida. We don't have a state income tax. But if you live in a state someday where you do have a state income tax, your state income tax counts as a deduction out of your federal taxes. So you'll want to be aware of that. It looks like, and they pretty much all look like this, because this is the e-file, this is the official IRS form W-2. Okay, so you get this, your W-2 from your employer. How much did you pay in taxes? Okay, so here we have wages, tips, and other, I can't even read that word, something, compensation. Then you have Social Security wages. You have federal income tax withheld and Social Security tax withheld. This is your federal income tax. This is your Social Security. Okay. Now down here, this is where you have state and local. Okay. These are her wages. This is her state income tax. And then this is her local income tax. And again, we don't have that here, but some states and counties do have state and local income taxes. So if you figure this out, we've got federal as 15851. We've got state as 534450. And then she's got local at 1092. If we add those together, that's how much taxes she paid for the whole year. So here we have another W-2. And on the actual note page, this didn't show up on there. I realized I hadn't put it on, so I had to go back and add it. So, but that's okay. You don't need it because we can just write down the problem. So we have two areas here. Do you see this? These are wages. We have wages, tips, and other compensation, and we have Social Security wages. All right. So our Social Security wages are $92,100. But in the wages and tips, it's saying $78,900. And we want to know, why is there a difference? Okay. This wages and tips, this right here, oh, I'm going to change color. These are your taxable wages. Okay, taxable wages okay, these come after tax-free deductions. So the difference between this and this is that this has had things deducted out of it. Now, Social Security is based on your total wages. Your deductions don't count. Whereas your federal income tax is based on your taxable wages, which are wages after deductions. So if we look at the rest of her pay stub, or I mean her, not her pay stub, her W-2. Okay, right here, she's put $12,200 into retirement. Okay. And then the other thing we have, okay, the other deduction we have is this right here. And we're going to talk about, we talked about cafeteria plans, flexible spending accounts? Okay, well, we're going to talk about those. Oh, that's next. Okay, this is another deduction, and it's called a cafeteria plan, and we'll talk about that in just a second. And that was for $1,000. Okay, these are tax deferred. You don't pay taxes on them. So it comes out of your total wages. So if I take her total wages and I subtract her retirement and I subtract her cafeteria plan, we get, oops, one too many zeros, we get her taxable wages. And so that's what the difference is between the Social Security wages and the tax wages, tips, and other compensation. That's why there's a difference in the amounts there. So this will only happen to you, that these two will be different if you have a retirement plan, if you have a flexible spending account, if you have certain insurances, or some companies offer like let you take out money for childcare, pre-tax, things like that. So that would make the difference. If you don't have any of those things, there won't be a difference between these two. Okay, these are retirement accounts, tax deferred contributions. Not every kind of account that you would use for retirement qualifies as tax deferred. Only certain accounts do. So not every 401k is tax deferred. Not every IRA is tax deferred. You have to find out when you go to open the account if it's tax deferred or not. Typically, though, employer contribution retirement, like retirement accounts that you do through your employer and they do payroll deductions, those usually are tax deferred. But still ask. It's always better to make sure. Okay, a cafeteria plan is where you take a portion of your pre-tax wages. Now, when you do your taxes, there are some things that you're allowed to deduct, certain medical expenses that you're allowed to deduct, and certain like child care, or if your parents need care and you have to put them in, an elderly care situation or something. Some of those are tax deductions. So the cafeteria plan allows you to take money out of your check pre-tax to pay for these things. So you don't get taxed on that money now, but if you do that, then you can't use it as a tax deduction later. So you have a choice. Like let's say my child's in daycare. I can either take money out of my check to pay for his daycare and I don't pay taxes on it now, or I can just pay for his daycare up front without using a cafeteria plan and use it as a tax deduction later. Either way, though, it's going to save me money on taxes. So it's just a matter of, do you want them to not tax you now, or do you want to get a better tax deduction later? And then a flexible spending account is an employee sponsored. Okay. Now this is a use it or lose it. Okay. money comes out of your pay pre-tax. Okay. But it must be used within a specified time. Or it goes away. So let's say I have a flexible spending account, and I put $1,000 that year into it, just whatever. And then I spend $900 of it on various whatever medical things. If I don't spend that last $100 by the deadline, for my flexible spending account, the deadline is April of the following calendar year, April 1st, actually. So if I don't spend that extra $100 by April 1st, it's gone. I don't get it back. The nice thing about this again, though, is it's taken out of your check before taxes, so it actually is money that doesn't get taxed. And a flexible spending account can be used for childcare, or it can be used for medical expenses. So if you have, like, if you know how much money you're going to spend on medical or childcare or something, these are really great because it comes out of your check pre-tax, and you can know exactly how much to take out and set aside. Works out nicely. Okay, so this is what a 1099 looks like, and this is used to report non-wage income. Now the deadlines are the same. Just like an employer has to have your W-2 to you by January 31st, anybody that has to give you a 1099, they have the same deadline. So if you have stock dividends, those companies have to give you your 1099 by the same deadline. So non-wage income, this is interest, dividends, contract work, royalties, etc., possibly tips. That would be on a 1099, yeah. Yeah, and this is, now if you got like lottery winnings, they would not give you a 1099 because they take the taxes out before they give it to you, right? I think so. I don't know, I've never won the lottery. But I'm pretty sure that they take the taxes out because you don't get as much as you actually win. So I think you get the taxes taken out. So a 1099 is money that you've gotten that tax has not been paid on. So like, have you guys heard of independent contractors? A lot of construction people do independent contract work. Seamstresses will do independent contract work, you know, things like that. So you go and you work for somebody and they pay you, but you're not an employee of theirs. So it's not considered wages because you're not an official employee. They'll give you the 1099, but they haven't dealt with any of your taxes or anything. You're responsible for that. So this particular one, there's $5,678.90 worth of royalties. Taxes will need to be paid on this money. So if this is the only earnings that they earned all year, they'll use the tax table and pay that. If they already had other income, like from a paycheck, they'll add this into their taxable income, and they may or may not owe money depending on if they overpaid or underpaid from their wages.